Thinking of getting a home loan? Before you sign anything, understand this. The right mortgage structure can save you tens of thousands over time. The wrong one can quietly drain your wealth. Most people think it's just about interest rates. It's not. It's about how your loan behaves over time and how much control you want. Let's get straight to the point. There are two main types of mortgage structures, fixed and flexi. Each comes with its own mechanics, advantages, risks, and hidden traps. Let's start with fixed-rate mortgage. As the name suggests, the interest rate stays the same for a fixed term, commonly 10, 20, or even 25 years. You lock in a rate. Your monthly payments stay unchanged. Simple. Why do people like fixed rates? One word: certainty. You know exactly how much you're paying every month. That's important when you're managing other financial commitments like school fees, car loans, or business cash flow. If the central bank raises rates, your payments stay put. That protects you. Let's take a real-world case. Say you fix your mortgage at 3.8% for 10 years. A year later, market rates rise to 5.3%. People with Flexi loans are now paying thousands more annually. But your repayment hasn't moved? You've locked in savings? This can add up to over $20,000 saved across the term. But fixed loans aren't perfect. The biggest drawback: lack of flexibility. You're locked in. If rates fall, you don't benefit. Worse, if you decide to sell your property or refinance early, you'll likely face exit penalties. And here's a common trap. A young couple buys a condo with a 10-year fixed loan. 3 years in, they get an overseas job offer. Now let's talk about Flexi loans. These are variable rate mortgages, but with a powerful feature. They're linked to a current or savings account. Any surplus cash you park there offsets your loan principal for interest calculation. Let's break that down. If your home loan charges 4.2% interest and your savings account gives only 2%, parking your cash in a Flexi account effectively earns you 4.2%. That's double what your bank would have paid you in interest, and it's tax-free because it's a saving on interest, not earned income. This is ideal for people with fluctuating income, freelancers, business owners, commission-based workers. This is your safety net. During good months, you dump in extra cash to reduce interest. During lean months, you withdraw it back. No penalty, no fuss. Now here's where it gets strategic. Let's say you just received a $100,000 bonus. Instead of putting it in a fixed deposit at 3%, you throw it into your Flexi account. You're now reducing your loan principal by $100,000, saving $4,200 annually in interest while keeping full access to that money. You can withdraw it tomorrow if needed. That's liquidity plus savings, something no fixed deposit gives you. Another real-life scenario. A couple is planning to send their child to university in 6 years. Instead of opening a separate education fund, they park that savings progressively into their Flexi account. They earn a higher effective return, save thousands in loan interest, and when university fees are due, they withdraw the cash. No penalty, no stress. Flexi loans also help pre-retirees. Suppose you're 55 and planning to retire at 60, you're still paying off your mortgage, but you've got decent savings. Rather than paying off the loan completely, you park your savings in the Flexi account. You keep full access to your money, but reduce your monthly interest. This approach gives you optionality, which is critical as you approach retirement. Now let's talk numbers. Let's say you have a $400,000 mortgage at 4.3% for 30 years just by parking $50,000 consistently in your Flexi account. You can shave off 4 to 5 years of your loan tenure and save over $40,000 in interest. That's without even increasing your monthly repayment. But Flexi loans aren't for everyone. If you live paycheck to paycheck and have no surplus cash to park, the benefits are minimal. Also, some banks charge a slightly higher interest rate for Flexi packages or require a higher margin of finance. It's not free money. You have to use it strategically. So, which is better? Choose a fixed loan if you value stability and predictability. You're on a tight budget and need consistent repayments. You're buying your first home and don't plan to sell or refinance in the near future. You expect interest rates to rise significantly. Choose a Flexi loan if you have irregular income or seasonal bonuses. You're disciplined about saving and want to reduce interest smartly. You plan to hold extra cash but don't want to lock it into fixed deposits. You value flexibility and might pay off the loan faster. Here's a tip most people miss. Some banks let you split your loan, for example. 50% fixed, 50% Flexi. This hybrid strategy gives you the best of both worlds. Half your loan stays stable, while the other half gives you interest, savings, flexibility. Before deciding, always ask the bank these 5 questions. What's the effective interest rate over 30 years? Are there lock-in periods or early settlement penalties? How is interest calculated, daily or monthly? Can I make extra payments without penalty? What are the fees for Flexi account, withdrawals or maintenance? And one final nugget, use mortgage calculators. Simulate different scenarios. Test what happens if rates rise 1 to 2%. Test how early repayments change your loan term. The more you simulate, the better your decision. Choosing between fixed and Flexi isn't just a financial choice, it's a lifestyle decision. Do you want peace of mind or control and flexibility? Do you plan to stay long-term, or might life take you elsewhere? The key is not to chase the lowest rate. It's to pick the structure that aligns with your goals, income flow, and risk appetite. That's how you turn your mortgage into a wealth tool, not a trap. If this gave you clarity, hit that like button and share this video with someone making a mortgage decision. In the next video, we'll cover how to negotiate the best rate, what hidden fees to avoid, and whether you should refinance your existing loan. Don't miss it.